First of all, thanks for coming along tonight. My name's Cole Wilkinson. I'm a partner with Pitcher Partners, a local accounting firm. I do quite a bit of work in the startup space with Jordan and everybody here at River City Labs to understand a little bit about some alternatives in terms of raising money. Obviously, you know, a lot of you, and it's pretty widely known, some of the stages that startups would go through to raise money, particularly in Australia and in Brisbane. So, you know, that's looking at things like angel investors, seed investors, and all the way up to sort of venture capital funds. You know, in Brisbane particularly, but in Australia, you know, even that part of the ecosystem's still fairly immature, but certainly it's starting to develop quite rapidly. And there's, you know, I'm not sure how many the number is, but you know, there's probably, you know, over 100 venture capital funds in Australia at the moment that are fairly active. For some companies, obviously, those forms of funding don't necessarily suit the business, or potentially, you know, they have used that funding and they want to explore some other alternatives for funding. Generally, you know, for bank funding is not an alternative for most startups because they want access to property. So that's why we're here tonight, to have a chat to these guys, just around what other alternatives are out there, particularly looking at some venture debt, so looking at some debt with a bit of a venture capital type spin, and also talking to Robert here from a corporate venture fund, and that's certainly something that I'm quite interested in. You know, for me, a lot of the large venture funds in Australia are actually coming out of the corporate space. I haven't come across them a lot, but there's certainly a lot popping up across a lot of Australian corporates and obviously some international corporates. So, so getting an understanding of what it's about, what you guys are looking for, and the process to go through. So, to kick things off, I might hand it over to each of you just to give us a little bit of a background of, you know, where you're from and what you've been doing, and we'll kick off from there. So just on the right here is Jason.
And thanks to the River City guys, thanks to Jordan, and thanks to Steve Baxter and everybody for inviting us here tonight. We're glad to be here, and it's just great to see so much going on in the Aussie tech ecosystem. You know, the first time I came to Australia looking to do deals from San Francisco in 2006, we did our first deal here in 2007. I would go around and talk to everybody about tech and entrepreneurship, and everybody wanted to talk about mining. So it's really good to see how much progress that the ecosystem's made, and that there's even places like River City Labs going. So thanks for having us, and glad to be here and tell you a little bit about venture debt. So I'm a partner in a venture debt fund based in San Francisco that recently opened up operations in Australia. So we opened a small office in Sydney about 10 months ago, but have been working in Australia for about 11 years. And have financed about 26 Aussie companies over that time, all in tech, fast-growing tech businesses here. So we've been a little bit under the radar, but with the emergence of the tech ecosystem and the momentum in the last 3 years, we decided that it made sense to have some people on the ground. So for a lot of you may or may not be familiar with venture debt or know what venture debt is. Maybe we'll just start very basic. What is venture debt? Venture debt really just means any type of a loan made to a fast-growing tech company. And if you think about it, if you're a startup, eventually you're going to need capital. You're going to have to raise that capital somewhere, and that capital is either going to be equity, venture capital, angel money, etc., or it's going to be debt. Typically, debt has not been available for startup companies because they're early in their life cycle, they're not profitable yet, they don't have assets. If you think about what banks traditionally have lent against, historically, it's been against assets or cash flow. And you have to have an operating history, and they probably want personal guarantees, and they want lots of other things. So they haven't been able to help young, growing companies. What venture debt tries to do is it tries to put a loan into a company at an earlier stage where the lender could take a little bit more risk, less risk than equity, but more risk than traditional bank debt. And usually venture debt is structured as some kind of a loan that's paid back over time. It's secured by the assets of the company, even if there aren't that many assets. The assets might be intangible or patents or customers or know-how, things like that. More nebulous assets than what a bank would typically be looking for. And in exchange for taking that extra risk, the venture lender gets a warrant or an option to buy stock in the company. So that allows the venture lender to participate in some of the upside of the company. And the trade-off there is that the entrepreneur gets lower cost capital because debt is usually cheaper than equity. Even venture debt is going to be a lot less costly than selling stock. The flip side is that debt has to be paid back, whereas equity's permanent capital. So it's kind of a cost versus flexibility trade-off. But venture debt is something that I think is new to Australia, but you're probably going to start to hear and see a lot more about it as the ecosystem continues to grow. So venture debt in the U.S. has been around since probably the mid-'80s. So it's a fairly developed market. Lots of startups in the U.S. take venture debt. If you think of names you guys would all know, Facebook, Google, Uber, Airbnb, all these companies have taken venture debt at some point early in their life cycle. It's a very established part of the capital market for fast-growing tech businesses in the U.S. There's probably about $4 billion a year of venture debt that goes into tech companies in the U.S. And there's no exact numbers on this, but it's probably 10 to 15% of the capital that goes into tech companies in the U.S. and the rest of that being venture capital. So it is a big part of the market in the U.S. It's pretty well developed. There's probably 15 players in the U.S. that do it. There's 5 to 6 banks, commercial banks, that actually focus on venture debt or tech lending, another name for it. Probably the most notable is Silicon Valley Bank. Some of you may have heard of SVB or Silicon Valley Bank. They're kind of the 800-pound gorilla of tech lending. They bank probably 50% of all startups between 0 and $1 billion of revenue in the U.S. So they've created a massive business as a bank just focused on tech companies and lending to those tech companies and providing banking services. So it's definitely a well-established market, and I think what we're hoping, we think we're one of the first ones that are down here in Australia providing venture debt, and the hope is that eventually, that it'll continue to grow, and hopefully there'll be some others.
Great.
Hello, everyone. Delighted to be here with you today. In my role at Salesforce, I look after 3 major areas. One is our investment activities across Asia Pacific. 2 is our programs for startups like yourself to help you build your business and accelerate on Salesforce. And then 3 is our corporate innovation. In terms of my background, I've lived most of my life in North America and London. I've done 2 startups, an airline startup, which we sold to EasyJet, and a technology startup, which we sold to Oracle, and for my sins, worked at Oracle for 6 years, and now I'm at Salesforce. So we can talk about that as well. What's it like to get ingested by a bigger company? In terms of our corporate venture activities, for those of you that are not familiar with Salesforce as a company, we started in 1999 to make enterprise software as easy to use as buying a book on Amazon. And back then, that was so provocative that I was chatting with the guys earlier, that our founder, CEO, Mark Benioff, could not raise money for that idea. And that ushered in enterprise cloud computing as we know and love it today as a mainstream concept. But back then, 18 years ago, it was truly groundbreaking. So over that period, we have gone from a 0-stage startup to the 4th largest software company on the planet right now, marching towards 10 billion. And we feel an obligation to send the elevator back down. And part of that is through our corporate venture activities, where we strategically invest primarily in SaaS-based businesses that complement our approach to grow the overall ecosystem. So we've got a clear thesis on the types of companies we like in terms of types of companies, in what they're doing, but also stage of company. So typically, in broad terms, we look for companies that are either built natively on the Salesforce platform, or integrate with Salesforce, or do something to make our customers more successful. So examples of that, there are companies like Autopilot, which is an Australian company now that has moved their business to San Francisco, that provides campaign marketing capabilities to the small, medium business sector. They're built natively on Salesforce. Their customers don't know that they're running on Salesforce. They go to market just as anybody else would, but they pull through the technology stack and they benefit from all of those capabilities. Companies that integrate with Salesforce would be some of the brands that you know, like DocuSign or Dropbox or Box, that they run in their own environment, but they provide an integrated workflow to do some business process. And then companies in the category that do something to make our customers more successful with people like MuleSoft or Evernote or Slack or Stripe or Twilio, that have capabilities that our customers would use to be more successful. We've probably done, over the last 7 years, we've invested in about 200 companies. We have about 11 unicorns. We've had about 40 exits and a few IPOs, 9 IPOs. We typically don't acquire the majority of the companies that we invest in, so it's not an on-ramp to acquisition. And at the same time, we don't put any onerous terms such as first right of refusal on the companies as a result. So that's our approach. Of those 200 companies, we have about 4 in Australia. So part of where our focus right now is to find more interesting companies to build that ecosystem. And as we continue the conversation, we can talk about what the trade-offs are from your side of the table in terms of all of the alternative forms of funding that are available today.
So I'm Karthi. I am a director at Partners for Growth. I work with Jason. Jason and I set up PFG in Sydney late last year. We've been financing companies in Australia for the past 10 years. So Jason used to fly in, fly out, and do a couple of deals here. But late last year, we just came to the realization that the Australian market has really matured in terms of the tech ecosystem. And venture debt has never been popular here because we've never really had a very mature tech market here. It's only beginning to take off. It's only in the last sort of 3 to 5 years that you've had a lot of funding. So because of that, venture debt hasn't really played a role because it's complementary to venture capital, which we're only getting a lot of at the moment. So having done a couple of deals per year, fly in, fly out, we decided, hey, let's set up PFG in Sydney and let's see how many companies we can finance in the market. And we were aiming to finance 4 companies per year, and we said that would be a good business for us. But I think we'll close out the first 12 months having financed 16 companies. So greatly exceeded our business plan. But what that really shows is that there's a need here that's not being fulfilled by traditional lenders. So if you're an Australian startup, Australian tech company, Australian high growth business, your alternative has always been either getting bank financing. But as we all know, the big 4 banks here love property. If they lend a business money, they're going to really ask you to put your property as collateral. So if you don't have property as collateral, or if you don't want to give your property as collateral, then the bank option sort of goes away. And then the alternative then is to raise equity, but equity is dilutive. So what we've provided to the 16 companies that we've financed is sort of a hybrid model where the companies get the debt, they get the capital they need from us. And together with that, we take a small equity warrant position, which is much less dilutive to these companies than raising straight equity. So maybe I can talk a little bit about the features of these companies that we've financed, because venture debt is not for, it's not for all types of companies.
Karthi, just on that.
Yeah.
Is, it's a question that I would get all the time from people looking to raise money, and whether they're talking to angel investors or a venture capital fund or someone like yourselves, is what are the key criteria that you're going to look for in a company? So whether that's their stage, their growth, whether they're pre-revenue, post-revenue, founding team. What are some of those sort of if there were 5 key things that you're going to look for before you even start to sort of delve deeper?
Yeah.
What are those things that sort of really you need to tick the box before you look a bit deeper at the company?
Yeah, absolutely. There are a few hygiene kind of issues that you got to look for in all companies. So a good management team, a product that's working, customers are really buying the product. So that's all hygiene issues that all investors, either debt or equity, is going to look for. But what we particularly look for from a debt financing point of view is Instead of saying, okay, does this company have hard assets or property that we can look to lend against, we actually take a much more broader approach to say, what's valuable in the company that the banks are not lending against? So that could be, that could be recurring revenue, that could be customers, that could be intellectual property, it could be technology they've built that no one has. So those things have value, and we can lend against that. So we look for, those sort of collateral, for lack of a better word. And the kind of companies that we finance typically at least have 5 million in revenue, but that's a number that Jason and I made up. Often we see companies that are doing 2 million, maybe not ready for venture debt yet, but because the companies that we finance are growing at 50% a year, 100% a year, in 12 months' time, they're going to get to 5 million anyway. So we start engaging with these companies very soon, but we're looking for some level of revenue before we start engaging. So look, if it's a company that's sort of growing at 20% per year, maybe not that attractive to us. But for us, the capital that we provide is very flexible. So we can adjust for things like slower growth rates by maybe asking for a bit more in the equity warrant position. So that's how we adjust. So we don't go in there and say if a business is not growing at 50% a year, we won't fund them. Rather, we look at the business and say, okay, it's doing 20% now, but with a bit of capital from us, can it get to 30%? So it's not doing 100%, but at 20%, can we maybe ask for a bit more equity and get more returns? So it's really flexible the way we look at it.
The business is doing 15 million in revenue versus 5, and if the 15 million revenue business is growing at 20% or 30%, that's different than the $4 or $5 million business. So as Karthi said, really we describe what we do as custom debt. So we don't go into any situation saying, here's our product, come take our product. We come in and try to understand what the capital needs for, how they're going to use the capital, and then can we get comfortable with the risk of a loan to this company, and how do we structure it based on that? So that's sort of kind of how we approach it.
Okay, great. Another big question just around the difference between venture capital and venture debt. Obviously, debt needs to be repaid. How do you structure that, given you're working with high growth companies? They obviously need some finance to help them grow. They have revenue, but probably not profitable in a lot of cases. How do you structure that in terms of repayment, timeframes? What do you sort of look to get out over a period of time, and how would a normal arrangement work from sort of finance through to repayment?
Sure. Right. Probably very few of the companies we finance are profitable, and they certainly don't have cash flow to service debt in the traditional way. In a lot of cases, you could argue that we're lending them the money to make the interest payments, right, or make the repayments for a while. So they may not have a fully funded plan. So it may be dependent on them raising capital in the future, or it may be based on a forecast that shows they can get to profitability. But often, all of us are involved in tech. Tech companies don't often hit their forecasts, so there's not always a full kind of source of repayment there going in. But what that means is we have to often adjust things. As things change, we have to adjust the loan and the way the loan works.
Mm-hmm. In terms of timeframes, do you have sort of a standard timeframe that a loan's over?
Sure, anything between 1 and 5 years.
Okay.
So it's very, getting back to the comment I made about being custom, it's really trying to figure out what the need is. Usually it's something in the 3 to 4 year range. So these are longer term loans, but 3 to 4 years is an eternity for a tech company. So a lot's going to change in 1 to 2 years. And most of our companies, even if we make them a 5-year loan, something's going to happen in that first 2 years, good or bad, and that company's going to do well, and it's probably going to be able to get cheaper capital, hopefully, and refinance us. That's what happens in a lot of cases, and we keep our equity. Or it's going to not go as well, and we'll probably still be in there, or it'll go really badly, and we'll have to figure out what to do with the investors and management team and everyone else. But tech companies are just so dynamic that the term of the loan is a stated thing, but it's often has nothing to do with when you get repaid.
you obviously got a bit of experience in the US doing this for quite a few years. What are some examples of debt arrangements that have gone successful, and maybe more importantly, the ones that haven't been so successful?
Sure.
And how did that sort of pan out?
Yeah, look, I mean, I think, debt's a really good tool. It's lower cost than equity, but it's nowhere near as flexible as equity. Equity's permanent capital, doesn't have to be paid back. If the company's, off plan, the equity guys aren't going to come and ask for their money back. So companies do have to be careful with how much debt they take on. And some situations we've seen over the years where companies get in trouble is, there's some lenders out there that are pretty aggressive, and they'll load companies up with too much debt. And then if the company struggles or it misses its forecast and it's got too much debt on the balance sheet, it can be actually hard to raise equity at that point. So you do have to be really careful how much debt you're taking on, make sure it's appropriate for the business, the size of the business, and your visibility into sales going forward, because the last thing you want is to get hamstrung with, bloated debt on the balance sheet and you can't even raise equity. So that's probably the biggest thing I've seen where it has been unsuccessful. Lots of cases where it's been successful. Look, probably the best example is a lot of tech companies, time is really an important feature for a tech company. Even an extra quarter or 2 quarters might result in a milestone getting hit, a key customer being added, all kinds of KPIs that can really change the valuation of that tech business. And if debt adds a little bit of runway to the company and allows you to hit a key milestone and raise capital at a much higher price or have some kind of step change in valuation, that can be really key. And that's where I think venture debt really adds a lot of value.
The capital that we provide will have a loan piece, and that can be either a term loan or a working capital facility. And together with that, we take a warrant. And on the loan side, we typically structure the loan, anywhere between 1 and 5 years, and typical duration probably about 3 to 4 years. And the warrant, it's actually longer dated, so it's 7 to 10 years. So even after the companies pay us back, we still have this warrant position ongoing. Now that's important because what it does is it incentivizes us to work with the company if there's a problem. So we've got covenants, like banks have covenants, and that's for us to monitor the company to see if they're performing to projections. And if the company breaks a covenant or things go badly, as a lender, we're not going to step in there and say, hey, give us the assets. We're going to sell and realize our debt, because we have this warrant position. And the way we structure it in PFG is to say, we are looking for a return for our investors because we're a private equity fund and we've got to send money back to our investors. And that return that we look for, half of that comes from the loan piece and half of that comes from the warrant piece. So the warrant's very important to us. So it incentivizes us to work with the companies when there's a problem and maximize the value of the company. So what we find is we're financing high growth companies, and when companies are projecting 100% year-on-year growth rates, sometimes they tend to slip up and they end up growing at 90% growth rates. And we're not going to say, hey, you promised 100%, now you're doing 90%, and we're not going to go in there and take the keys from there. So we'll work with them and try to realize the value of the company.
I think one of the best ways to answer the question is to start by, from the company's perspective, who's looking to raise the money, understanding what your needs are. And typically, I would encourage you to think about answering three questions. One is, what is your strategy? 2 is, what stage you're at? And then 3 is, what are your fundamental needs? So in terms of your strategy, it says, how are you thinking of going to market? Are you planning to be part of a larger ecosystem? I'd probably argue that every tech startup business today should have an ecosystem strategy. Like, are you planning to build your own ecosystem, or are you planning to be part of someone else's ecosystem? And the reason why that is important is because that provides leverage, that provides velocity, that provides a number of intangibles that you can't do by yourself, right? And it's oftentimes harder to build your own ecosystem from a zero stage than it is to be part of someone else's ecosystem. So it doesn't have to be Salesforce's ecosystem. We'll try to convince you that we've got a great one. But there are other ecosystems out there. There are other technology players like ourselves that have thriving ecosystems. There are other corporates, whether it be a bank or a telco, that has their own ecosystem. So you have to evaluate, does your strategy align with the corporate ecosystem who represents the corporate venture fund? So that's the first point. The second point is, what stage are you at? Because certain equity players only play in certain stages. Salesforce, for example, we typically get involved in growth. So we look for companies that are looking to raise Series A and above, which means if you are looking to raise seed funding, then it's probably not a great conversation. It's not a great match at that point in time. Are you looking for tens of millions of dollars, or are you looking for $1 to $2 million? Again, that will determine which VCs or which corporate ventures you should probably spend time with. And then the third point is, what are your specific needs? Are you just looking for cash, which probably you can find from a variety of sources, but are you looking for access to talent? Are you looking for access to markets? Are you looking to go global? Are you looking for customers? That again will inform whether or not you should spend time with this venture capital fund or with this corporate venture fund. I think in the end, the other important point is, for the most part, it's never a question of either or from a corporate venture versus pure VC. Because typically, most corporate venture funds come in alongside regular VCs. So for us, we never lead a round. We participate as part of a syndicate. So we will work with other VCs that are taking the lead, setting the terms, etc. And we think that's our role. So as a result, we don't take active board positions. We observe. So we don't want to be in conflict with the VCs that are leading the round. So that's probably the guidance I would give as you think about it. I think one of the things that's really encouraging here in Australia, I've been here now 5 years, and even in that period of time, you've seen a true renaissance of venture capital. Right? You've seen a number of really great venture capital firms that are founder-led, people that have built businesses and have been in your position, that are raising second and third funds and are now looking to work with corporate ventures like ourselves. The last point I'd make is, spend time, particularly for corporate ventures, spend time understanding their strategies, right? To make sure that it aligns with your strategy. And what I mean by that is, are they just looking for innovation sourcing? Are they just looking to find interesting IP in the market? Are they looking to build businesses and partner along the way? Is there strong executive sponsorship within the organization for the startups that are coming in? Part of the value add of working with a corporate venture is getting plugged in. Is getting plugged in, if it's a technology company, getting plugged in with the engineering teams. If it's a bank, it's getting plugged in with the lines of businesses where they can start taking advantage of your capabilities. And if there's not strong sponsorship on the way in, it's going to be a challenging relationship to navigate, because large corporates can suck the life out of you. It's a fact. So you have to have a sponsor to help you navigate that entity. Otherwise, it's going to be an elephant dancing with an ant, which is never a good rhythm. The sponsorship for us is really technical sponsors, which are our senior product leaders back in San Francisco. And without that, we probably would not move forward with a transaction, because that's vital for us, and we think it's a strong indicator of success. It really shows that there's excitement on our side for what you guys are doing, and then it really helps the marriage be successful. So from a sponsorship, that's what we look for. Can we get our technical leads excited about the business that we're looking at? Sure. Me? Well, look, we're early on in the Australian journey. So we spend most of our time at co-working spaces like this, because what's nice about the Australian ecosystem is you're beginning to see hotspots where there's good density and there's good activity. So that makes the challenge a lot easier, because many people don't know that we're in the game. Many people don't know that Partners for Growth are in the game. So we do a lot of hustling. We spend a lot of time on aircraft, spend a lot of time getting the message out and really demonstrating the fact that we can help you on your journey. Because fundamentally, I think that's when you look for an equity partner, you are enter into a partnership that's probably a 5 to 7 year journey, right? And you want to be as rigorous as we are in qualifying the opportunity. I encourage you to be equally rigorous in qualifying us, because you are entering into a marriage, and we want that marriage to be successful, and it shouldn't be something that you take just casually.
So for us, I mean, we look at probably the best place we get deals from are former clients. So we've got now 26 Aussie companies that we've financed, and so 26 management teams that we've become friends with, we've gotten to know over a long time, and we find we get our best leads, the most curated leads, people who understand exactly how our debt financing can help a company at a certain stage comes from that cohort. Another bucket we look at is going out to the community of service providers. So it'd be people like Cole, who we've worked with a bunch, accounting firms, law firms, corporate advisors, other people who have deals. That's sort of the second bucket. And now that we're new here and new on the ground, we're trying to build that out. We know a few people, we don't know that many, so we're working on expanding that network. And then the third bucket is, which we've actually had a little bit of success with, somewhat surprisingly to Karthi and I, is occasionally we'll actually cold call people that we hear about and read about. And that's actually produced a couple of really good deals. Those are kind of our three main buckets. But it is, as Robert alluded to, it is a lot of shoe leather at this point.
Great.
Ultimately, we have to figure something out is the honest answer, and it's situation by situation. But our incentives are to work with the company and to try to figure out a way to restructure the loan, either lengthen the repayment, change the terms, figure out a way to make it work. It's in our interest because we own equity in the company, and so we're aligned to try to make that equity valuable. And so if refinance is not available, we're not going to just turn around and run and ask for our money back. That would destroy a lot of value. And also, what we found over being in this business, Partners for Growth since 2004, and then our predecessor firm since the mid-'80s for 30 years, is you get a lot better outcomes as a lender by working with companies, working with the team, working with the owners, the board. We get better recoveries that way than being heavy-handed and saying, well, the contract says this, so we got to stick to that. So,
I guess just on that, one benefit for both parties really of having a finance arrangement where there's not this sort of property backing it is it's not in your interest to sort of pull the rug out from underneath them and sell the house because there's nothing to sell. So
that's right.
A business is only worth something while there's probably the founders in there driving it forward. So it makes sense to work together.
It's a very good point. Absolutely. I mean, a lot of times the technology relies on a couple of key people at the company, or customer relationships rely on that. And so preserving that value is very important to us, especially when it's not going well. And a lot of times we build up a lot of goodwill and trying to make it work for the company and doing things that we don't have to do that the contract doesn't say, and that buys us a lot of goodwill with the entrepreneurs and the board. And often they will, if it's clear it's not working out, they're still working hard to try to pay the loan back, which is great for us. I always learned when I was learning about lending 15 years ago and getting trained in credit and things like that, there are only three things in the world you can lend against. You can lend against assets, you can lend against cash flow, or you can lend against enterprise value, which is this nebulous concept of what the company's worth. And so we look at all those, and some companies will have some assets, they'll have some debtors or inventory or fixed assets. Usually they're pretty asset light, so we're not going to be completely covered by assets typically in a deal, but sometimes you have some assets. typically we don't have cash flow, so we'll probably throw that one out. And then the last one's enterprise value. And that's a hard one as a lender. You can't look at any one thing. And every company is going to be different. You know, a SaaS company with 10 million in recurring revenue and 100 customers and low churn rate, that's worth something. But what is it worth? And you know, what kind of product is it? What market's it going after? What's that worth as collateral to a lender? I don't know, but it's worth something. And so trying to get a determination on that, or maybe it's a key patent or a key piece of technology that we think has value. So it could be a lot of different things, and a lot of it is pattern recognition, and myself and my partners doing it for a lot of years and figuring out what has worked and what has not worked, as far as when we've been left with something to clean up and sell. Historical experience plays a role in it.
So a lot of it is upfront risk management, like Jason said, but a big part of it is also ongoing risk management. So the way we structure deals, and without getting into too much technicalities, we have things like covenants, monthly reporting. We meet with the management companies regularly. We don't have management rights or board seats or anything like that. But as a lender, we have information rights. We monitor the companies. So we also do risk management after the deal's done, and often we can sense 6 to 9 months before something bad happens because they've broken a covenant or something like that. So before things get really bad, we can work with the company to find a solution. So it's also risk management after the deal's done.
My response to it is venture capital, and corporate venture is a category of venture capital, is really about investing in people more than anything else, right? You're investing in, the investor is trying to make two decisions. Is this an interesting space? And is this a team that we think can get it done? And those are the two fundamental questions you're trying to answer. And if the answer to that, to both questions, is unanimously yes, then that's a no-brainer. Oftentimes, it's a really interesting space, but there are question marks on the team, or vice versa. On the team, typically you look at things like track record. Is this their first go, or have they had any demonstrated success? The composition of the team, like if it's a technology-based company, is there a strong technical founder, even though this may not be a serial entrepreneur, but the technical founder has real bench strength. That's going to be important, because a large part of the success of the company is underpinned by the technology at that point. We also look at things like if it's a multi-person team, the chemistry between the founders, because once again, if you're going the distance, the relationships are going to be important. And then the X factor is really, are they going to stay in the fight? Is there passion that's demonstrated? Not that they're climbing up on the tables, but you can really see that the founders want to have an impact. They want to change the world. They are looking to build a business and not necessarily get a short-term outcome. So those are probably the things we look at most. Just to add a little bit more to the question, again, we look at later stage growth companies. So the other thing that we factor in is, has the model been proven? So you pass your product market fit. And one way to demonstrate that is you've got customers, you've got low attrition rate, and you've got recurring revenue. And if the founders can tell a Cogent story about how they got to that point, that in and of itself adds to the credibility.
We definitely look at track record. We look at team composition. We probably don't have to be as right on that. It goes into our risk assessment, but we don't have to be as right on that as if we were buying the stock, because we're still making a loan at the end of the day. And we do work on the team, but it's we could be wrong on the team and still probably get paid back on the loan if we've done the rest of our risk assessment right. With that said, what I've found historically is in situations where things don't work out, the type of people you're working with is really important. because you really find out when everything goes great, everybody's happy, right? Everybody's friends and everything's up and to the right. That doesn't happen very much. Usually there's bumps. And when you really find out about, how people are and how they behave in those kind of situations, and I think of the times in the past where we've lost money or we've had problems, it's often with, it gets back to the people, and we've probably missed something. And I think about a couple deals we've done where we actually had questions about one of the founders, or we had questions about the CEO or someone who was involved, and our gut said not to do the deal, and we did it, and usually that hasn't worked out. Yeah, I would recommend that people, to the points that have been made about checking on us, the people you're getting money from, ask for references. And don't just ask for the couple good references that everybody's going to give you. Ask for a couple references on a deal that didn't go well. And that's where you really find out what the financial partner's like in a bad situation. First of all, can they even give you any of those? Will those people even talk to them anymore? Or are they happy to talk on their behalf when something has not gone well? I think that's more important than just getting the standard one or two good references. From a debt perspective, probably when they get to 2 to 3 million run rate revenue, at least for PFG's perspective, for where we could start helping and starting to add value. Before that, it's probably too small for us to help much. We'd still be happy to talk to anybody and see if we could introduce them to angel investors or other people we know in the ecosystem. But as Karthi mentioned earlier, we do like tracking companies early. We just closed a deal this week for a company that we've been tracking for 9 months that was about 2.5 million run rate when we started talking to them, and they're at more like 4 now. And again, we were able to kind of follow their journey over 9 months, get to know them, watch them execute, and then we were able to do something for them. So I think around that time for us, from a debt perspective.
It's always better to raise money when you've built up some intrinsic value in the business, because it allows you to extract better terms, right? But from a corporate venture standpoint, later is always better than earlier for a couple of different reasons. One is if you're going to get value from the partnership, you want to be at the stage where you've got the capacity in the business to get put into the machine. And what I mean by that is, one of the things we do is we plug the startup companies into our customers. And that there's a certain expectation that you now can handle a volume of customers coming at you. And if you can't, then that's a bad experience for you and it's a bad experience for us. So stage is really important. The other thing is, if you are approaching a corporate venture, think carefully about what is your proposition to that bank or to that telco or to that technology player like ourselves, rather than thinking that the corporate venture is going to sit and figure it out. Because I think if you've done, back to my earlier point of figuring out what your strategy is, if you can come to the table and say, we believe that we can really add this to your ecosystem or to your partners, and we've done it with a couple of customers here, and we've already begun to see joint customers, so there's market validation for the synergy, then that's a much more compelling way to go forward than being much earlier in the process.
I don't think it's ever too early to have conversations, because when you meet an investor, what you don't want to be is a dot to them. You want to be a line. So what I mean by that is when you're ready to raise, when they're ready to write a check for you, or even have that term sheet conversation, they should know who you are, what you've gone through, what you've built. They need to have a story about you. And that's an approach that worked really well for Jason and myself, because that enables us to fund companies that we typically wouldn't. Because this company, Glam Corner, for example, and Jason's wearing that T-shirt from our client. Yeah, so we met them when they were really tiny. But one of the things that Dean Jones, the CEO, did was he would send us updates every month on how he's doing, unsolicited. He was hustling as well on the capital raising front. but unsolicited. And he probably took 5 minutes of his time, unsolicited, give us a short note to say, hey guys, this is what I'm doing this month. And that, in our minds, built a story about what Dean was doing with the company. And when he was ready to have a chat with us, we were happy to speak to him, even though he wasn't at that 5 million run rate, because he built that credibility with us. So he was a line to us, not a dot. So keep talking.